Now exclusive, and the government and regulators, we understand, are keen to get the trading of Nifty futures back to India from Singapore and are taking a variety of measures to attract FIIs to India for a 24/7 Nifty futures trading, as it's losing out to SGX Nifty on trading volumes as well as revenues, as the SGX Nifty will cease to exist from August 2018. Ajay Sharma, my colleague, joins in with details of a mega road show that Edelweiss Capital has conducted in Asia last week with Gift City management precisely for this purpose. Ajay, what more details are you picking up from this mega road show which took place?
Good morning, Aisha. Aisha, our habit of watching SGX Nifty every morning, I think, will have to change very shortly. By the looks of it, in fact, data does indicate that SGX Nifty, which used to trade over 1 lakh contract almost on a daily basis, the volumes have fallen to just about 50,000 contracts. Just this Friday, Edelweiss Capital's prime broking team has come back after a big road show which they have conducted in Singapore and Hong Kong. They took along the MD of Gift City and other key officials of NSE as well alongside. And our sources say that it was a very well-attended road show. Of course, the subject of the road show was that SGX Nifty will cease to exist from August 2018, as Finance Minister has already indicated, and the government is trying to move overseas trading of overnight Nifty futures back home. What they are trying to do is that they are moving the instrument which is like SGX Nifty to Gift City, called International Finance Center IFC, which will also offer similar kind of a Nifty futures on an overnight basis. So before I come to you, how exactly will the this instrument work? This will be a 24/7 instrument, no taxes for FIIs, and I'm told that some of the top-notch blue-blooded FIIs in Hong Kong and Singapore have attended, over 100 of them, like Siganti, Treeline, JP Morgan Asia Desk, Macquarie, and Oppenheimer among as well. So they are planning to do similar roadshows in US and UK as well. So that's the update which we have got in short.
Okay, Ajay, thanks a lot for that. Vikas Khemani, President and CEO with Edelweiss Security, joins us. Vikas, good morning. Thank you for joining us. Is it true what Ajay is reporting, that most of the brokerages are now officially marketing the Gift City because SGX is going to be off the radar?
Good morning, Nikunj. I think Gift City is a very long-term, promising destination. In my opinion, government is committed to make it happen, and I think the development which we are seeing currently are very, very promising. We think over the next 5-10 years this will become a very, very robust trading center, and we've been investing in over the last 2 years, and it's just that right now with this new development there is renewed interest in exploring how to sort of set up there, how to kind of trade there, and I think it's going to take some time, but there is definitely lots of interest in exploring ways to start trading there.
Okay, Vikas, today we've invited you for a big picture segment, and before we talk about your two themes, one which is your bullish on road construction and the entire GST impact, the organized sector will benefit, organized sector would benefit because more business will shift from unorganized sector to organized sector. I want to just get a quick market view going. Do you think worst of the fall is behind us? Do you think, if not the absolute low, but we are nearing the lows of 2018 now?
Nikunj, I think we are in a very, very interesting phase of the market where macro factors are slowly and steadily becoming difficult. Interest rates are going up, liquidity situation is going to get a little bit more tighter as we move along in the year. There are a lot of political events ahead of us, and while the good part is that earnings are looking up, lots of ground level activities are picking up. So I think there is going to be good, interesting tug war in this year between fundamentals and the macro factors or sentimental factors, and this will keep the market fairly volatile. And when this kind of situation is there, you would never know that in short term what can get pulled off, what kind of situation can occur as far as the liquidity is concerned. I do see definitely quite a bit of headwinds as far as this rest of this year is concerned, but silver lining is that corporate earnings are picking up, corporates are guiding well, and from which has been elusive for quite some time. So, but having said that, you can see some sort of downside coming through due to liquidity factors. One of the big risks I see is if at all the tapering of domestic flow comes up, any disappointment happens on the mutual fund flows, you could see some sort of again consolidation. So the way I see this is going to be a consolidation year, making a nice base for sustainable or nice base for returns in years to come. And there will be great investing opportunity if at all market sells off. If there are some major liquidity driven corrections, there will be great time to kind of look at and build portfolio.
Vikas, hi, morning. So you're not completely ruling out that the worst is behind us in the February fall, right? You do sense that there could be some more sharp corrections that we could see in the latter part of the year.
Yes, it is quite possible. It cannot be ruled out. I think we have still 3 Fed rates ahead of us. As I said, that if domestic flows disappoint us in March is the month probably will continue to still robust flow, but how it goes about April, May, June, and coupled with lots of political outcome, so it will narrative is going to be a lot more cautious, lot more volatile. That kind of environment is there. Typically flows tend to slow down. General narrative you would have seen is of muted kind of markets. So it's kind of catch chicken and egg. So I do believe that there is a possibility of, if in case some sort of disappointing event occurs, there is a possibility of a correction which could be a little deep. But again, these are the things one can never rule out. One can never predict what will trigger them, what kind of how deep it can go. But one should be prepared for those kind of things. When you are managing a portfolio, the leverage in the portfolio should be less, in my opinion, this year. You should be having definitely some sort of defensives in your portfolio. So these are the kind of things you do when this kind of environment is there, rather than having a very aggressive portfolio. And you will see throughout this year, this kind of phenomena continuing, in my opinion.
Okay, fair point. So it's a catch-22 situation, Vikas, that you're saying that, there is going to be global volatility on one end, and in the run-up to the 2019 elections, there's going to be our own domestic political volatility ahead of the big event. And then, of course, there are all those heightened inflation, etc., and bond market volatility concerns too. So how is it that investors should balance both these risks out? Like you're saying, it's best to stay put within defensives. Within defensives, where could investors hide? And in this corrective mode, where could one buy in? What are the themes? What's the big picture that you think is best poised for investment right now?
So I think, we are going through a very interesting phase. And in my opinion, one theme which cuts across, a lot of things is that currently in India, there are lots of companies which have high gross block, capital WIP, and the very, very moderate kind of earning. And in my opinion, having capacity will become at premium. No new large scale big capacity can come up, or nobody would like, given whatever is happening around in the banking sector, in the environment. So I think all the people who are having capacity will become at a premium. Also, I think, given the trend of deglobalization, local capacity will become, very, very valuable. So I think, and this cuts across fairly wide variety of sectors. But this I like as a theme. Whenever the earnings start picking up, and it is only a matter of time, you will see huge amount of value creation happening in this as a theme. So, and this again cuts across many, many sectors. So that as a one particular theme I like. Secondly, I think, financial remains one of the biggest theme, given the current interest rates and all those things. In my opinion, right now, you've seen some correction. You might see some more correction. I don't know. But, fact of the matter is that we are seeing a shift of market share from public to private. Penetration is still low. The growth can continue for next 5 to 10 years. If India has to grow, credit has to grow. So across the financial services space, in my opinion, there is so much opportunity. You can create, huge amount of wealth. And this year, you have to, as and when those kind of opportunity presents, you have to look to, add to your portfolio or stay put on them. Because I think that theme is not for 1 year, 2 years. That theme is going to stay for, if your belief in India story is there, India $5 trillion economy is there, which I do. I think financials cannot be ignored. And third thing, which I think, which is
Right.
very, very important, I think, the government is spending a lot in terms of building across railways, roads, urban infra, affordable housing. And if so much of money is going to be spent, somebody got to build them. Somebody got to, kind of do it. And if you see sector which was completely ignored in about 4 or 5 years ago, EPC and infra, has now come back, and I think this is again beginning of a very long, sort of, you will see the contours of sectors changing, competition is less, corruption is less, capital cycles have reduced. So I think these are working in favor of this entire sector, and I think this is going to continue for at least 3, 4, 5 years.
Okay, so Vikas, what we'll do is that we'll take those themes forward, and your first thing which you said is that you should bet on the fact that unorganized player will lose out, organized players would gain out. So that really could be the GST theme which could be at play. And the best, one of the best way to really bet on this theme is that you bet on the entire plywood sector. According to the data what we have, 78% of the plywood market is dominated by unorganized players. 50% of the tile market is dominated by the tile player, and nearly 55% of the total laminate market is also currently dominated by the unorganized player. These are large pockets of unorganized activity where there is going to be a sizable change as Indian per capita goes higher after the GST rollout, and there would be a conscious change in buying pattern by the so-called brand owners who understand how to really value good quality even at higher prices. So let me now bring on board Mr. Keshav Bhajanka. He's Executive Director with Century Plyboards. Keshav, good morning and thank you for joining us. It's been almost 9 months for the GST rollout, and the big thesis markets were betting on was the fact that unorganized players will lose out, organized players will gain. So 9 months into the GST rollout, what has been your experience in terms of the market share shift?
You see, at the moment it's very difficult to actually calculate the market share shift. The primary reason behind that is that the e-waybill has not been introduced yet. So while the GST regime came into play on the 1st of July, the state checkposts were removed, and it became actually easier for the unorganized sector to transact as compared to earlier. Whereas once the e-waybill comes in, we will see the true effects of GST and we should see compliance increasing. So as of now, I don't think there's been any major impact on the unorganized sector. Once the e-waybill is levied from the 1st of April, I think we will see a drastic change between the unorganized and the organized.
Because I'm sure you have a follow-up question, because as of now there is no big change, but Keshav feels that the change is coming soon. So what could be your follow-up question, Vikas, to Keshav?
Keshav, I think, so would you like to share how it is going to be over next, once e-way gets introduced, and over next 3 to 5 years? Obviously, GST cannot have a significant impact, from immediate effect. And also, what do you think, would be impact of huge amount of investment in the affordable housing space? Do you think that is also going to add to your, growth of this segment and sector?
Definitely. You see, already we have seen a slight benefit from the rate of taxation being reduced from 28% earlier to 18% today. Earlier, the cumulative effect of taxation on the plywood industry was 28%, which is 14% VAT, 2% CST, and 12.5% excise duty. From the 15th of November, that has already been reduced to 18%, and that will definitely benefit us. Going forward, once the e-waybill is introduced, I believe that the share of the organized market should increase from 30% to close to 50%. So I see a 20% shift upwards in terms of the share of the organized market within the total market within the next 2 to 3 years. Other than that, affordable housing, I believe, is going to be a thrust area for the government. And if that happens, as we are seeing signs of today, there is going to be a huge increase in demand for panel products or for all plywood and plywood related products across India. If we take an example, today the government is talking about commencing 50 million homes by the year 2022. 50 million homes would tantamount to 250 million doors being consumed, considering that's a 2 BHK, which would result in a 50,000 crore demand for just doors being created between now and the year 2022. So that is a huge quantum that will be added in just one segment. So overall, we should see a definite improvement. We should see a definite increase in revenues and in terms of turnover.
Right. Keshav, in that same vein, where do you think lie the biggest risks for some of the plywood companies such as you? Because, you know, some of the reports that we've been scanning, they're saying that aside of the real estate sector slowdown, although that glimmer of a hope of a pickup in affordable housing that the government has its thrust on, there's also raw material security, there's excessive competition in the MDF segment, there's also foreign currency fluctuation, which could be posed and poised as big risks to your industry. Would you concur with the same?
Well, no, I actually don't agree with the above. I believe that in terms of the market is growing at a rapid pace. So overcapacity definitely should not be a risk for us. In the short term, yes, it might have a certain impact on prices and margins, but going forward, I really don't see that as a challenge. I think the biggest challenge would be how to handle this increased market share. Today, just by banking on GST, I don't think any company can benefit from the true effects of market share gain. We'll have to be active in the market, and we'll have to ensure that we are the gainers behind this sizable shift from unorganized to organized. And I think for this, we need to be very proactive, and we need to ensure that we maintain the momentum in the market.
A decade ago, when organized retail was introduced in India, all of us thought that the Kirana wala would die. All of us thought that the Sabji wala is not going to exist. But frankly, it's the organized retailers currently who are feeling the heat, and the Sabji wala and the Kirana wala has not died. So do you think to assume that there would be a significant shift from unorganized market to organized market? It's great on paper, and I hope it happens. But do you think in a country like India, it may not hold true entirely?
I am banking on the fact that it will not hold true entirely. Hence, we are not looking at a shift from 30% to 50, 70, 80%. We are looking at a 20% shift from 30 to 50%. The reason behind this is that in the year 2007, we faced a similar situation where the excise duty on plywood was reduced from 16% to 8% in the union budget. That change resulted in an increase in the share of the plywood, the organized segment of the plywood industry, from 10% to 30% over the course of the next 3 to 4 years. So this being a fairly larger change, I am assuming that it is going to lead to a change from 30 to 50%. So we are being conservative. We know that the unorganized sector will not die out, but at the same time, GST and the e-way bill will definitely have an increase in the share of the organized market.
How will 2000, or let me rephrase it, how will FY19 be different from FY18? Because the e-way bill would be introduced, GST in a sense would have become the new law, and the supply chain would have also adjusted. So purely because of the GST effect, how do you think your needle would swing in FY19 for Century?
I think we would have a sizable volume growth. I think we would be looking at close to 25% plus value growth in the year FY19. Alongside that, as you said, the change in supply chain dynamics would also lead to a certain upswing in margins. So I am very bullish on the year FY19. I think both volumes and margins are going to be on the up.
Any follow-up questions with Keshav?
I'm good.
Okay, so you're convinced that Century is a good stock to own, Vikas?
I can't comment on that, Nikunj, unfortunately.
Okay. Keshav, appreciate your time and thank you for joining us on today's episode of Big Picture. The idea here is really to get thoughts from Vikas and some of the themes which he's betting on and why he feels that the entire GST implementation is going to be a big game-changing move for the entire space, for the entire unorganized market versus organized market. Because plywood is one clear category which would be a beneficiary of this trend. Which are the other categories or subcategories where you think that this swing factor would be at play?
I think there are many, especially building materials is definitely one big category. You can go into tiles, pipes, even in, if you ask me, healthcare is again a very big theme on that, where unorganized to organized shift is happening. So I think the key thing you have to see is unorganized to organized is not only because of GST. Unorganized to organized shift is underway for 3-4 reasons. I think premiumization, which is underplay, technological things underplay, change in technology, regulatory definitely plays a very big role. So there are multiple factors which are driving this unorganized to organized shift, and all of them are at play with a different intensity. So in general, and GST has only accelerated in some of the sectors we had historical India specific issue. So I think that is changing. So I say it will cut across many sectors. Even if in some sense you can say, when financials, when we are moving from the typical lenders to the organized lenders, you are seeing that kind of shift also taking place. So this is a larger sector, but GST driven sector will be where huge amount of unorganized players were there. Dairy is another sector where we are seeing a big kind of move happening in favor of unorganized, from unorganized to organized play. So this is going to go on for some time. Food processing across the board, you will see changing slowly in favor of organized players. So this is a very big large theme cutting across many sectors.
Okay, another segment which Vikas highlighted towards was infrastructure, the opportunities that are arising from the capex recovery. There's better working capital, which is now leading to upgrades. So who better than N.K. Khemani, the senior ED at Simplex Infra? He joins us on the show right now. Mr. Khemani, morning. Thanks so much for joining in. We've got Vikas Khemani as well from Edelweiss joining in, and he believes that the infrastructure story is here to stay. And we've seen that really in the kind of order flow that some of the infrastructure companies like yours as well are building in. Considering you're a large conglomerate with presence across key segments, be it building and housing, power, urban infrastructure, roads, etc., where is it that you're seeing maximum traction within the infrastructure gamut pick up in?
Actually, the urban infra, which includes metro, airports, urban water supply, urban sewerage, roads, affordable housing, power transmission, and railways, and now also the shipping, the port sector. These are all seeing a lot of traction in the bid pipeline and the bidding activities, and also in the order book. Affordable housing also is adding a lot to the order book and also bid pipeline. So entire infrastructure sector, including housing, is growing. Only sector which is lagging behind right now is industrial sector, which will have the effect. Once the infrastructure demand grows, then cement, steel players will start investing more, and that sector will also pick up in activities.
Vikas, and this is a segment again, which you've talked about often. We're seeing that visibility kick in. We're seeing some of these infrastructure players bag in orders on a daily basis. But considering how large the infrastructure umbrella is, everything from urban housing to roads to railways, development, etc., where is it that you're seeing maximum growth visibility within the entire infrastructure umbrella?
I think each of these segments are so big. Take it railway, it's so large. I mean, anyway, they are going to spend anywhere between 7 to 8 lakh crores over the next 10 years. So I think it's so large. We have never seen this kind of size of the projects investment coming through. Affordable housing, 1 to 1.5 lakhs crores of investment every year. You are going to see stock creation. You are going to see every year. It's very large. Urban infra, there are I'm told about 40 odd places. Metros are being planned now. Each metro is very large, project depending on the size of the city. So I think, currently we are at a phase where each of these buckets are themselves very large, and you are seeing a fairly wide and cutting across these sub-segments, as Khemani was saying, in all of these segments, very large planned spent, getting done. And companies which have, capability to execute contracts across these categories, companies which have capability to execute complex capability and manage large scale contracts. So far historically in India, most of the companies were managing smaller contracts. In the new life, I think now you are seeing contract sizing changing. In railways, earlier contracts used to be 50-100 crore. Now we are seeing 500 to 1000 crore kind of contracts becoming order of the day. So this is a very big shift. So companies which are positioned to handle large scale contract from a balance sheet perspective, execution capability perspective, delivering on time. So those kind of things, those kind of companies will definitely benefit, and we are seeing many of them are already scaling up their order book, they're scaling up their execution, growing very, very well. And I think this trend is going to continue because and you need a lot of localized expertise to manage this kind of complex execution of contract given setup in India. So all these factors will definitely augur well for all these construction companies.
So Khemani, my follow-up question would be, what about bank funding? I met a couple of CMDs of PSU banks post the PNB scam. And the sense I've come back with is that right now PSBs or PSU banks are a big source of funds for road construction companies, for construction companies. They're giving you all the necessary collateral and all the bank guarantees. But the sense I've come back with is that they are going to be slightly reluctant in their entire lending activity. Is that a serious challenge for you? Because if the funding dries up for this sector, then there could be a vacuum.
Actually, that is not a challenge as of now, because for the companies who have been performing well, you see, that challenge has occurred on the companies who had invested heavily in the ownership projects. But for the EPC contractors whose track record has been good, I think we have just now increased our working capital limits, funded as well as non-funded both, and banks have tied it up. So there is not a reluctance on the part of the banks when the companies have good balance sheet, good track record, and good financial servicing levels.
Of your order book, Mr. Khemani, and how much of your order book will be executed in FY19, and how much of your order book may not get executed in next 12 months?
Out of 19,000 crore order book, we expect that FY19 8,000 crore will be executed. 8,000 crore will be executed. That means about 35 to 40% growth over the current year. And the remainder order book will get executed in next 1.5 years' time, because there will be new orders coming in simultaneously also.
I encourage you to jump in with your thoughts, and if you have a question for Mr. Khemani.
So Khemani ji, would you like to share, given the lot of businesses coming through, what impact it is going to have on the margin profile of these companies, and secondly on the working capital cycle? As I understand that working capital cycles in construction companies, that's going to be very, very important. Historically, that has been big concern of the sector, but I see that changing. But would you like to share your thought on the margin profile, change in the margin profile, and change in the working capital cycle of the companies in general, and in particular for Simplex?
You see, I would like to give the complete picture on the entire sector, how much is the pie and how the pie is going to rise, and that will affect the individual's profit margins as well as the working capital. Actually, India is currently spending only 5% of GDP on infrastructure, which is about $125 billion annually. And if you see, most countries, developed countries, have spent up to 10% of their GDP in infrastructure during their growth phase. China is even currently spending 9%. So if we go, our economy grows up from here to 5 to 10% kind of spending, and also economy is rising on real term basis by 8%. Nominal basis, economy is rising by 12 to 13%, and construction will be rising faster than the economic growth rate. So I believe that from $125 billion currently, in 5-6 years time, this total pie will be about $500 billion annual spend on infrastructure, which is from 7.5 lakh crore to 32 lakh crore. So it gives opportunity for all existing players to grow at least 35-40% every year. And of course, the growth in infrastructure sector will be higher, and then the GST and demonetization impact will also bring about greater share of the organized players like us. And secondly, some of the players have become financially weak, so the competition intensity has gone down. Therefore, the margins have improved not only because of the pricing power on the rising demand, but also.
Mr. Khemani, we got to leave it there, sir. Really appreciate your time and thank you for your valuable thoughts. And because before we wrap today's episode of Big Picture, we've always spoken about themes, ideas and stocks, but every investor has a unique way in which you look and judge the market. I mean, traders, they follow momentum, value investors, they follow value, growth investors always look at good opportunity. So in terms of an idea generation, a thought which always has affected, has always influenced your investment process, which is your favorite market thought and your favorite market book?
So Nikunj, I like to kind of look at, because I believe that big money is made when there is earning growth and stock re-rating. So typically situation where there's a combination of both is possible. I'd like to kind of look at and typically look at the bigger theme at play, and then I try and identify good quality, good managements who can build a scale in that segment. And if you can get a situation where there is a big uptick which is happening and either the stock is disregarded or either stock is sort of under owned, and you can find a significant change in either due to cycle, due to change of any underlying factor. So I look at typically 2 out of these 3 things should be there in any investment to make big money out of it. And if you see any value investor, any sort of investor who looks at margin of safety, typically these are the characteristics they would look at. And I have been always influenced by some of the great minds, and I'm nowhere close to so you always kind of read, learn from great minds like Warren Buffett, Mr. Junjunwala, Sage Klarman, Mark Howard. So there are lots of great minds who kind of teaches you that how to invest with a significant margin of safety, and when you get your call right, you should tend to get both re-rating as well as significant uptick in the earnings. And if you have these combination of these two, you will definitely make big money. And if it is also backed by a big theme which can sustain over, let us say 4, 5, 10 for a long period of time, then you get into a stock early on or a sector early on and ride through the wave. And that is what, in my opinion, thematic investing does to you, and also reduces the risk of anything going against you. And to my mind, that is very, very sort of critical when you start investing into markets.
Oh, absolutely. And all wisdom is welcome. Vikas, great chatting with you today. It always is. And thanks for sharing a big picture idea. It sure is a volatile time for the market. So how best to invest? You just heard from Vikas Khemani and the themes that he's betting big on.